Good afternoon, everyone, and thank you very much for joining me today. Today we're talking about an investment which is designed specifically to enter into the market in a high fear environment when a market might be crumbling, looking at a 2-year time horizon with an expectation that the market will be trading higher and significantly higher than it will be at its low point over the next 6 months. I'll quickly just go through sort of the general housekeeping matters to this session, but please note that if you want to ask questions at any point in time, put them into the chat box. There should be a chat box open at your screen. If it's not open, a red arrow top right-hand corner should get that open for you. My name's Patrick Nelson. I'm the Managing Director of Reach Markets. Welcome to the session today, and thank you for taking the time to joining us. Any advice contained in this presentation is general only. It doesn't take into consideration your personal circumstances. You need to decide for yourself whether it's appropriate for you, and past returns are not an accurate indicator of future returns. Today we are here to talk about what is happening to our market. We're talking about where beyond what is happening immediately at this point in time in front of us and what we expect to happen over the next 6 months, what beyond there, and how do we position ourselves to preserve our wealth or make a sensible entry into this very high for year market, and how to do so in a way where we can cap our downside. What's going on at the moment is unprecedented, right? This is a weekly chart of the global financial crisis, which was at this point in time, I think 47 bars on this chart takes us to where the market had come off 34%, right? And if anyone remembers and, what it was like during that period of time, and I know a lot of you on the session today will, it was high fear, it was high stress, we were concerned with what was going on, and there was a lot going on at that point in time, right? And as a result, the volatility was trading up. It was sort of, people were talking about this once in a lifetime event. Let's have a look at now. So this is 2020, and I created this chart on last week's chart. The market's traded off since then. So from the 47 weeks to 34% or 32% drop, we did 38% in around 5, right? And it's extremely, it is unprecedented. We haven't seen anything like it. Volatility went from 11% up to 79%. I haven't checked what it did on Monday, implied volatility, what it did on Monday, but probably around 80%. This is unheard of volatility, and the increase of that volatility as well. So what's going on? Why is this happening? Well, we all know, right? We've now got an event which is something that we don't understand. We don't understand the implication that it will have on businesses. We've been, as a business, we've been going long volatility over the last 6 months and looking at investments that can benefit from long volatility. I guess that most of the market was shortfall 5 weeks ago. And we've seen hedge funds blow up, billions of dollars being wiped out. These hedge funds, it's over for a lot of these groups. They've been completely on the wrong side of it, and a lot of people have been caught by surprise. Then what happens is we're in a position where the fear, we know that at some point in time in the future things will get better. We don't know exactly when that will happen, but we know at some point it will happen. And when we can see clearly what that looks like, the market will have already moved, right? And the rebound will occur. So we want to look at, well, how do we set ourselves in the current market, knowing that, or having a view, and if your view is that in 2 years from now, we'll have got through this fast pull-off once there's clarity on the other side. Will it be priced in? It'll be priced into company valuations. Not all companies are going to make it, by the way. There will be lots of downgrades, but 38% on Monday pullback from the top. A lot of that is being priced into what's going on. So there will be opportunities out of there. Wealth will be created. The biggest movements in wealth happen in periods like this. But how do we set ourselves for this particular market? And so that's what we want to talk about. How does this end? Well, You know, this is a slide that from about 6 weeks ago that I had in a presentation for a dispersion long volatility trade that we were looking at doing, which is a trade that we've done a lot of times in the last 6 months, a 2-year investment, which has done incredibly well recently for us. But this slide was referencing this black swan event that we saw in coronavirus. And I run a trading group discussions each week, and you know, when we were breaking up to 7,200, volatility was sitting at 11%. But at the same time, we're talking to businesses, people that we know well, friends, family, clients. We've got a lot of clients that run businesses, big businesses, and they are saying, you know, our occupancy rate has dropped from 90% to 50%. This is 6 weeks, 7 weeks ago, before we saw the massive pullback. At the same time that's happening, we're seeing the market break through 7,200. We're seeing volatility go in a range of sort of 13% to 11% to even into the 10s at that point in time. It was just madness, right? This black swan event, which occurred, which we didn't believe would occur, we had plenty of evidence to see that things were going to kick off from around the world before it joined us here in Australia. And but where does it go from here? We think this fear, this panic is still there. We're not saying it's going to stop today, tomorrow. We believe that it will be around, and it is something that that we're looking at very, very carefully. There are other factors that don't go away. You know, sort of the markets are crashing. We're seeing this occur. We believe it will continue. There are trade wars that have not gone away, that will be there at the end. There are factors that occur, but beyond all of this, right? We do believe that one day this guy will be back. The bull will be back at some point in time. And we are worried. We are concerned. We're looking at how do we protect ourselves. We're looking at safe entry. We're not wanting to rush. We want to be patient, right? But this guy, when he comes back, we've seen what's happened out of the global financial crisis. 1 year after the low, the S&P 500 was up 71%. Dot-com bubble, 35%, Black Monday 27%, and then after that, the second year after that, strong returns as well. The growth out of these types of markets, we believe, can be very strong. It has come off incredibly quickly because of the uncertainty. We believe that with certainty coming back, and there are unknowns in there, that it can also move back, but we are not in a rush, right? So the Optimiser product is a way to get exposure to the US, to the S&P 500, have capped downside on your risk, and be in a position where you can, it's designed to help you optimize your entry point. Why are we looking at the US market? Well, this is what the US market did after the GFC versus what the Australian market did after the GFC. So the Australian market was a lot more sluggish coming out of the GFC than the US market. You know, people will have an opinion about the US market, and by all means do, but why do we think that it's likely that the American companies will perform better? Well, ultimately, or the market will be, it ultimately comes back to the strength of the businesses that exist in the US. You look at information technology on this slide here, and this slide's a little bit dated, it might be a year old, but 2.48% versus 24% in America. What type of companies are we talking about with Facebook and Google and, you know, Amazon and these types of businesses that are on a global scale changing the way we do business, changing the way we behave, and capturing our business at the same time, right? Well, what are our banks going to do to innovate from here, right? What is the material sector really going to do coming out of this crisis? Is it going to be in a position to go in leaps and bounds? Now, these businesses, I'm not saying they're not going to recover and can't recover strongly, but underpinning it strategically, what is it that they do that is going to help them grow significantly? Or are they going to be under threat by Google Pay? Are these businesses under threat by Amazon and so forth? So we think that we're going after US exposure. We're not saying for a moment that there aren't really good businesses to invest in Australia. We will be investing in Australia, but just from this type of a market-based play, we believe the US is a better position. All right, and coming out of these troughs, you know, since 1929, after a year of a trough, the average gain for the US S&P 500 has been 47%. All right, and we want to be in a position where we can capture that type of a gain. This investment is also has a capped downside, so we were able to go in there, get our exposure up front and cap, right? So what I might do is just run through the numbers of how this investment is designed, and then I'll talk through the actual structure of the investment. So the numbers behind it is if you wanted a if you wanted to get an exposure of $100,000 on this investment, your net outlay would be $14,900. It's a 2-year investment term. So the maximum money at risk is $14,900, and your uncapped upside is based on 100,000 exposure to the S&P 500, and it is a 2-year investment term, all right, and pays out at the end of the 2 years. So that 100,000 is made up by prepaid interest of 11,900 plus an advisor fee of 3,000, which is 14,900. Right, so that is the cash flow at commencement. The 14,900 is the total exposure on your investment, so that's your maximum risk. There are no margin calls. There is nothing else that happens on this investment other than that 14,900. All right, so the investment is designed. The entry point to the investment is it's set to give you the ability to enter in at the lowest closing level over the next 6-month period, right? So it allows us time to, or allows us the ability to time the market over the next 6 months. So if it continues to fall, then it gets better, right? So our entry point gets better. And there is, someone's just asked me saying that they don't have sound. If I could just get someone else to sound check me quickly to say, confirm that we've got sound. Someone can say sound, type in, I can hear you. Yeah, okay, thank you. So it must be just that person. All right, so it allows us to time ourselves in. If it falls, it gets better. But if it rises, this trade trades on the 31st of March. If for whatever reason we go, okay, well, this is as bad as it's going to get, and I'm not sure that's going to be the case, and the market it finds a low after in March, then the 31st of March will be our trade date, and in we go. If it continues to fall off from that point in time and we go down another 20% in August, and that's our low, then that is our strategy, that is our trade price, right? There's a volatility exposure rate which allows us to take a position like this in this high volatility market that we're presently in. So our exposure on the investment increases when volatility goes down, which is generally when the market is stronger and going up, and that mechanism allows us to be able to trade into the market at this point in time. All right. Okay, yeah, Vincent, yes, we'll go through those numbers for you again. All right. So this product was put together and negotiated with the IB before this pullback occurred. So this was back 6 to 8 weeks ago that it was set up, and so I'm not sure we'll get the same pricing if we would have priced this up in the weeks to come. But it's great, and from that perspective, it gives us the ability to go in there. All right. Now let's have a look. All right. So I'll just go through a case study. So if the market goes up. So let me just run through the numbers that are on this. So your total net cash outlay over the 2 years is 14,900, right? So that's that first column there. That gives you an investment amount of $100,000. If the market goes sideways or falls, that's your maximum risk. That is what you lose. If the market is up 25%, then your final coupon on maturity is 25,000. So you put in 14,900, your coupon's 25,000, you've got a 67% return. If it was to go up 50%, then it's a 236% return. If it was to go up 75%, 403%. If it is to double, then it would be a 571% return. All right, and Alison, who's asked the question, is this available to download the slide deck that I'm going through? It is. It is available on Reach Markets website. If you go to investments, choose Optimiser, it's already on that page, right? And the presentation I did last week is also on that page last Thursday, so you can rewatch that. We'll update it with this one later on today, but all of that information is available there for you, Alison, if you want to review it in more detail. All right, so they're the numbers. That's the setup of this particular investment. So the exposure amount, and people have been going with different levels of exposure amount. If you want to get 50,000 exposure, it's 7,950. and you can see the numbers going up and down from there. So that is the exposure amounts that are going through there. All right. We like this investment because we're not in a massive rush to go and put all our money into the market at the moment. Rather than taking $100,000 to get exposure to the US market, I'm able to move in to that investment with just $14,900. Right, the maximum I lose is $14,900, but my exposure is on $100,000, and I get to time the market over the next 6 months. So if your view is over the next 6 months, most of the fear, we're not saying the problems are going to be over, but the fear and the panic selling, most of that will have washed out over the next period. Then we can position ourselves at that with that look back functionality at that lowest point and position ourselves for a bear market rebound, a post-trough rebound, as we've shown. We're able to do it onto the US market, and as a result, that is we're able to do it in the US market. So therefore, we believe that will be the stronger market on the rebound. Vincent's asked me the question, prior to this Black Swan event, how is your current portfolio doing? Vincent, I'm in 100% cash at the moment and was prior to the market pulling back on my superannuation portfolio. I have got some stock exposure which isn't doing great, but that's fairly minimal onto the smaller cap stuff, which I'm in a patient, and I've got real reasons for owning those companies and still have a lot of belief. And then I'm invested in a lot of companies in an unlisted way, all of the businesses, every business is affected. My business is affected. We're all affected by this. No one's at this point in time on hand sanitizer. Our trading business is doing incredibly well, but no normal businesses are not affected by this. So Vincent, to answer your question, everyone's navigating their way through this, but for me and Ivan, both of us who run a trading business together have both gone to cash a little while back. So we're not on the public markets, generally speaking. Why is the entry cost for this? David Calder, entry cost, I don't know that I understand your question. Let me go back to the previous slide. So the exposure, the investment amount is $2,800. So that is the total investment amount, and that gives you $200,000 worth of exposure, David, right? So I hope that answers your question. Let me know if you need to. Now, Vincent, Vincent's asked me, will I explain the technicals? Let me go back to that. Let me go back to that question at the end. Let me just finish off these next couple of slides, and I'll go back to all the questions that are coming through. Again, the numbers, I'll just go through them. Net outlay, $14,900 gives us $100,000 exposure over a 2-year period. Maximum risk, $14,900, $100,000 exposure to S&P 500. All right. And we know the investment term, all right, uncapped upside on the 100. Warren Buffett, he's had a bit to say recently and still has been a believer. I haven't seen his latest and greatest commentary, but as of last week, I like to buy stocks. We're hearing all the statements, and we go back and look at the Rothschilds of buy when there's blood on the streets, Warren Buffett, buy when people are fearful. Yeah, we think there's going to be probably more blood on the streets. We think fear is going to accelerate over this next period of time, and then we think there will be a period of time where, as Warren Buffett would say, it will rain gold, right? There will be an entry point which will be maybe a once-in-a-lifetime entry point, right? We've certainly seen from our traders they've been making once-in-a-lifetime trades on the downside. We believe that they're on the upside. Over this next period of time will be that opportunity. And that is what this investment is designed to do. It's exactly the type of investment we've been looking for. Going back, we had a long volatility trade that we were unable to fill because the volatility got away from us too quickly. So that last dispersion trade that we were looking at, the vol spiked before we could get the trade away into the market. We immediately started thinking about, well, how do we then position ourselves based on our next view, which is, and it hasn't been like a lot of the industry professionals have been talking about, stay calm, wash your hands, this will blow over. I just don't know how you could think that would be the case by observing the fear and the volatility in the market that existed, and it still exists at this point in time. I don't understand how anyone could feel that that would be the case. And so we were very much looking for trades or an investment that can position ourselves for where we are and position ourselves for where we expect, what we expect to play out over the next 6 months. We don't know if it's going to be 2 months, 3 months, 4 months. We believe it will be in the next 6 months. And if it's not, we don't think we'll be too far away from where that bottom will be in the market. And this is a way of getting exposure to that, so that looking over that medium term to say that we believe this guy will be back. We believe that the events post GFC will be something like what we see coming out of this market, and that there will be people that have the fortitude and the foresight to position themselves for this to be able to play out. All right, and that is what this particular investment is designed to do. All right, so from here, if this is something that you would like to get some more information, if you want the PDS sent through to you, type in yes and we will get it sent through to you. All right. It's a limited recourse loan, so you can use it through and make an investment through a self-managed super fund. There are no other obligations. All the amounts are paid up front, and it gives you an investment with capped downside but uncapped upside. So if you would like to get the PDS, simply type in yes and we'll get that sent through to you. All right. You know, go and have a look back at technical. Someone was asking me for a technical view, and I would like to say that you know, we're you know, I can't give you a technical view that I can match something that's happened similar, but I believe that the fear selling will probably see a rebound, which will be pretty similar to the sell-off. Maybe not as quickly back on the upside, because we're going to have a wash-off of economic problems that come through this. But what we're seeing at the moment is selling that is occurring through the uncertainty that is in the markets, and that fear and uncertainty is driving it. More so a prediction of what's going to happen economically. Think back to the GFC. Think back to the conversations we were having with ourselves at that point in time. People I know well that were in the market were talking about buying gold and burying it under their house, right? It wasn't like there wasn't a lot of fear. There wasn't like it wasn't a lot of concern about what was going to happen to our financial markets and the like. And so that is there. We believe there will be continued fear over a period of time, but this investment gives us the opportunity to set ourselves over the next 6 months. The 6 months, Noel, starts from the 31st of March. That will be the first period. So there will be 6 monthly periods after that. All right. Now, for anyone that would like us to send you out the PDS and populate the amount of exposure that you would like to take on it, simply type in the exposure amount. So if you want to take $100,000 worth of exposure, type in 100 into the chat box, and the guys will send your pre-populated form out there with the exposures amounts in there, and they can they'll get that across to you, and pick up the conversations from there. If you want to speak to the guys in the office, just call the office, obviously off the Reach Markets websites, all the information that you need there. And if you haven't already put in the chat box the amount of exposure that you would like. All right. Now, I would welcome questions, and I know that quite a few people are putting in exposure amounts, and that you will have further questions. Just simply speak to David and Blake in our office for that. This trade closes at the end of the week, right? So we're on, what is it, Tuesday today. To participate, you would need to be getting your paperwork back by Thursday at the latest, and organising payment on Friday. It trades on Monday, so you know, we understand that this is all happening very quickly. Receipts and things like that would need to be coming through so we can confirm trades. All right. The investment date is it will trade on the 31st, which is Monday, so it will all be happening pretty quickly. All right. So when someone's just asked me what is this trade, the investment is made. All right. So that initial the 1490, if you did $100,000 exposure, that trades on next Monday. All right. Funds and trades. If it's not Monday, it will be Tuesday. All right. So it happens to that schedule. All right. Vincent's asked about you assume we're using. So this is you know, a investment that is put together with the investment bank. So it's designed with an investment bank. It is designed for institutional investors who are seeking to trade a particular view. So what we previously had was an investment for hedge funds managers who were wanting to go long vol, and we used that as an investment that we could give to our clients over the last 6 months, working on the basis that volatility was low. We didn't know where a correction was going to come from, but we've been in a bull market for 12 months. I just want to point out a couple of things about the market that we've been in. If you look at the Australian market, we went up from 6,800 in 2007. We got back to those levels. We're only at 7,200 when the market pulled off. The exuberant buying that occurred pre the GFC wasn't there. We were a lot more temperate in our buying. Now, not to say that people might argue things were overvalued. We were concerned not so much based on the valuation. We were concerned about headwinds coming from a black swan event that we didn't know would occur, that would cause fear in the market. Not this particular one. This is something else. This is next level to all of that. But not having the levers that we would have from a monetary policy perspective that, okay, well, we're sitting at 6% interest rates. Let's drop them 0.5% at a time down to 4% to give people more money back on their home lines or whatever it might be, or, things that we can do to say, drop the Aussie dollar to improve this or whatever it might be. We didn't have the levers that we needed to be able to navigate us, and we thought that as a result that these incredibly low volatility levels wouldn't be maintained, and even just a move back to normalised volatility on that basis of that trade would have done us really well. Moving back to where they are will have done incredibly well for us. And moving to our next view, we're now saying that our expectation is that there is a significant buying opportunity in the market over the next 6-month period to be able to set ourselves up. All right. Now, the other side of this, Wayne, is what happens if this IB fails. We're talking about JP Morgan, Citigroups, those types of companies. So the counterparty to this is not a small firm. It is a significant firm. The product issuer is Sequoia. If something happened to that business, then you face off with the investment bank, and a decision is, do you want to continue with the investment or do you want to cash out of the investment? Would be what happens there. We're not expecting anything like that to happen, but it's a very good question. You always want to know who your counterparty is. Tim, Tim's asking, will we be selling puts, buying calls? That's not exactly how this investment works. I'll get David to run that through with you and how that mechanism works. Rowan, this investment cuts off on the 31st of March because this is one trade that occurs, right? So we're not edging in. This is an investment negotiated with the IB pre the events that have recently have occurred. After that investment is made, we will seek to negotiate new terms with that bank and other banks for investments that we believe will be suitable through this period. It might be this one. It might be slightly a different approach. We might go after one particular sector that we believe will come back a lot harder than others or be more defensive, and we will come back to you with ideas beyond this. But this investment will trade on the 31st, and then after that, new pricing will be applied. It might not be the pricing that we were able to achieve with this one, and we will look with our eyes open for other opportunities and maybe come back to something similar to this at a later point in time. But this is what was made the most amount of sense to us at this point in time. Right, so if you haven't already requested the PDS, type in yes, and if you want to get in there and you want to get in there and put and request the PDS with an exposure amount, just type in the exposure amount in there and we'll sort that out. This is not hedged, Kevin, on exchange, so that is a factor. All right, we have a view on that. Happy to talk you through it. Just to confirm, these prices were locked in pre-crash. Benson, so this was negotiated pre-crash. The valuation of this investment was negotiated pre-crash, but the value, the strategy value, will be determined over the next 6 months. So we're not locking the value, the strategy value in until after, in this 6-month period, we're able to look back and see what the lowest closing value was at the end of any month. All right, so our strategy value will be established over this next 6-month period. All right. Let me just go back. There's been quite a few questions and make sure that I have answered every question. Someone's asked, can you invest via SMSF? Self-managed super funds, you can. You have to have a self-managed super fund to be able to invest, or it can be direct investments, but you can't invest via your retail super funds into this particular investment. So it'll be SMSF or direct otherwise. Okay, so Rowan has said, so a large investment bank is putting out a single big trade into the market to get more funds, right? So this is an investment product. The investment bank, no doubt, and the people that put any of these things together are doing it because they want to make money. The actual deals are ideas that quite often will come out from investment banks that we'll be looking for to see what they come up with. And that meets what we're trying to go after, and they'll have a range of different ideas. This one is one that we like, right? So there are a bunch out there that we don't and wouldn't be going after as a result. Please, details of the trade, please, i.e. the nature and the components. Vincent, the PDS will give you all of that information. That's probably the best thing to do at this point in time. I'll get that across to you, all right? Okay, so the performance fee is based, someone's asked about the performance fee. There is a performance fee charged by the manager. So if this was to double the numbers that I provided you based on 20%, 25%, include the fact that a 10%, being, let me go back to the fees, the returns, sorry. All right, so if the return is 25%, then at the end of the gain and the percentage of a 67% return, total net, that is net of the performance fee of 10% that is being taken out, and that is paid to the manager who constructed the retail prospectus. All right, so that is how that works. Rowan's asking, anyone from IV personally taking this up? In short, yes, there is quite a few. All right. Beautiful. Okay, guys, any other questions, please send them through. If I haven't answered, there's a list of lots of yeses and notes and things like that, probably 100 things long, so I might have missed a specific question. If I haven't answered it, it's not on purpose. I'm not ignoring you. Please put it in and I will answer it. Look, guys, from here, first of all, I want to thank everyone for coming onto the session today, and I honestly know that this is a very, very trying time for all of us. Our business has been operating remotely, 50% in, 50% out. We've been taking extreme caution. No one touches anyone else's desk, equipment, social distancing is there. We've not had a meeting in the last 2 weeks. We're using all of those things, and we're wanting to continue our business. We're wanting to be around to provide our services, and we're wanting to support people through this and keep communicating with people throughout this time. We are working on a number of things at the moment in the background to position, working with our private equity partners to look at how do we best position ourselves, one, to help Australian businesses to be able, really good quality businesses to be able to continue to operate through this period and come out the other side, and to help investors to be able to support those businesses and really probably obtain once-in-a-lifetime opportunities to be there to reconstruct and come out the other side. So we're going to be working on that part of what we're doing. We're looking for investments to help you guys position yourselves. We're working hard on the trading side of the business to keep our communication up, to help you understand how to trade through these periods. We're doing everything we can on that regard. We really thank everyone for taking the time to getting onto the session today. If you need anything else, please contact our office. You can call our office and speak to people. You can email us and come in online. This is the final session we're running on this particular investment. We'll be closing it over the coming days. For everyone that has requested, and there are a lot of people, we'll work on getting the prospectuses across for you today, and we'll follow up with phone calls to make sure you get all your questions answered. Blake and David will be David Sellers and Blake Reed with the people calling you. If there's a particularly good time to speak today, type it into the chat box and we'll make every intention to call you. If you want to call our office right now and speak to someone and get your questions answered, I'll just put the phone number in. that should come up in your chat box. We're talking to our team, and I implore everyone. This is a tough time. Personally, in our businesses, in our lives, we've really just got to stay active, keep thinking, understand the environment that's going on around us, and take every step we possibly can to put ourselves in a position to come out the other side of this in best shape we can. It's going to be tough. I wish everyone all the very best. Thank you for coming on to the session today, and if you've got anything else we can do to be of assistance, please don't hesitate to get in contact. Thank you. Have a wonderful day. When you drop out of this session, there is an opportunity to leave us some feedback on the session. We'd appreciate any feedback you can give us. Thank you and good day.